Welcome back. Today, we're breaking down the big shifts happening in the market, the ones that are hiding just under the surface. So let's get right to it. Everyone's asking the same questions. Is the AI boom over? Is the S&P 500 just too concentrated to be safe? You see the headlines about all-time highs, but you can feel that something's changing. And these aren't just random worries. They're pointing to a huge shift that's already underway.
And this really gets at the tension that's building up. On the one hand, the index is going up. Looks great, right? But underneath, the number of companies actually pushing it up is getting smaller and smaller. It's a quiet change, but it changes everything, especially if your whole strategy was just to buy the index.
Here's the new reality. We've just walked into a market phase where a company's actual earnings, their profits, matter a whole lot more than the hype around the chips they're buying. In this explainer, we're going to break down what we're calling AI Phase 2, why it's so important, and how you can see what's really going on. Okay, so let's dig into this first big idea. The rules of the game have already changed. The shift has begun. You've probably heard analysts worrying about market breadth lately. All that really means is that a tiny number of giant companies are doing all the heavy lifting for the entire market. They're pushing the S&P 500 higher, but it's masking some real weakness everywhere else. It's a classic warning sign that things aren't as strong as they look. And that brings us to the new reality. The old playbook, just buy an index fund because a rising tide lifts all boats, well, that's getting a lot riskier. We're now in a phase where quality, I'm talking real profits, strong business models, that's what's going to drive returns from here on out, not just hype. So what exactly is this AI Phase 2? Well, to really get where we're going, we've got to be clear about the phase we just left behind. Phase 1 was all about the build-out. It was the gold rush, right? Everyone was buying the picks and shovels, the GPUs, the cloud space. Companies were spending billions, thinking only about growth, not profit. And back then, a good headline was all you needed to make a stock pop. But now we're in Phase 2. This is the application era. You could call it the show me the money era. The market is done with promises. It's asking one simple, really tough question. Can you actually make a profit from all this AI stuff? It's all about cash flow now, not just cool-sounding concepts. And look, this isn't some far-off theory. We literally watched this whole shift play out in real time over one single pivotal week. It was incredible to see. Just look at how the psychology changed in 5 days. On Monday, everyone was getting nervous about crazy valuations. By Wednesday, the conversation turned to, wait a second, can companies really make money from AI this quickly? And then came Thursday, the great divergence. This was the moment everything snapped into focus. This brings us right to the heart of AI Phase 2. The new rule of the game is simple. It's all about earnings, not headlines. This is a perfect tale of two companies that tells the whole story. On the exact same day, you had Snowflake, which reported decent numbers but got punished because it said, our future isn't looking as bright. And then you had Salesforce, which got rewarded because it said, our AI products are selling like crazy right now. The message couldn't be clearer. Promises are out, profits are in. And it wasn't just Salesforce. UiPath, an automation company, saw its stock jump for the same exact reason, a strong outlook. The market is literally drawing a line in the sand. It's separating the companies that are actually using AI to make money from the ones that are just talking about it. It's a big deal when even the central banks start chiming in. The European Central Bank basically came out and said a lot of these tech stock prices have been pumped up by pure FOMO, the fear of missing out, not by how well the business is actually doing. That's a huge sign that the era of easy money and pure hype is coming to an end. And you know what's interesting? As investors get pickier, they're starting to look at so-called old economy stocks again. Think about it, insurance companies, consumer brands, energy producers. Why? Because in this new world, they offer something that's suddenly very attractive: stable, predictable profits. Okay, so what do you do with all this? How do you actually navigate this new environment? Well, you need a new playbook. All right, here it is. Step 1, you have to look beyond the big index. It's just not telling the whole story anymore. Step 2, focus on who's using AI to make money, not just who's building the tools. And step 3, and this one is crucial, start thinking of market dips as your friend. They're your chance to buy into fantastic companies when they go on sale. So at the end of the day, it really all boils down to this one question you have to ask yourself with every decision you make. In AI Phase 2, are you investing in hype, or are you investing in real tangible value? Getting that right is probably going to be what separates the winners from the losers in the years ahead.
If you want to go even deeper on the structural analysis behind these themes, we have our full note available. And for anyone who wants to understand the market quietly, structurally, day by day, you can follow us on X. Thanks for tuning in.